Hi, this is Rob Wilson from Instant Trading Results. In this video, I'm going to teach you an incredible strategy called call vertical spreads. But first off, I need to read this disclaimer to you. Unique experiences and past performance of anything discussed or demonstrated today is not guaranteed and may not indicate future results. Examples are non-representative of all trades. Certain trades may have substantially worse performance than indicated. All markets have inherent risk, and there is always the potential for loss. Today's lessons are for educational purposes only. I do not have a financial services license, nor am I licensed to give personal financial advice. So again, today's lessons are for educational purposes only. So now we've got the formalities out of the way, let's get into some great learning. My objective in this training is to teach you how to protect a naked call by buying a further out of the money call for protection. Now I'm assuming that you've already watched my previous videos. You really need to watch the very first one, which is my options essentials, and then you need to have watched my writing naked calls. Then the progression is going into this video, which is teaching you how to protect that position. Now, not only does this trade now give you a defined risk, it also reduces your margin requirement. Depending on the price of the stock, many times the ROI, or your return on your investment, on a vertical spread is greater than actually selling the naked option due to the margin requirements. Now, some people say, no, you should write a naked call and not write a vertical spread because you're paying money for that protection. So that's going to reduce your income. Well, one, yes, it does reduce your income because you're paying money for that protection. However, your ROI, your return on investment, is quite often greater because the margin requirement on this trade is far, far less. So less money involved in the trade. Less money gives you the higher return. Now, my main goal is for you to learn how to be an option seller with a defined risk strategy. So what are spreads? Well, when you buy and sell an option with different strike prices on the same stock, you have created what is known as a spread. The spread is the difference between the two strike prices. You can create both credit spreads and debit spreads. Now, I wonder which one you think I prefer, to bring in a credit or to pay money out in a debit. So credit or debit spreads, you can create both credit spreads and debit spreads. Firstly, a credit spread is a spread option position in which the price of the sold option is greater than the price of the bought option. So you're selling one option to bring the premium in and you're buying the other one to give you protection. Now the second spread is the debit spread, a spread option position in which the price of the bought option is greater than the price of the sold option. Which do you think I prefer? Do you think I prefer money coming in, or do you think I prefer money going out? The answer is an absolute no-brainer, isn't it? I prefer to create credit spreads as they put money into my account, while debit spreads cost me money. My trading goal is to make money, not spend money. And as they say, possession is 9/10 of the law. When the money is in my account, it's mine, it's in there, and time decay is eating away at that option, which is making it harder and harder and harder for the option buyer. Remember, I am the house. I'm the casino. Okay, the house always wins. Well, not always, but most times the house wins because it's stacking more odds in its favour. And that's what I do with my trading too. Call vertical spreads, some important entry guidelines. Sell a call at a price that you do not think the stock will go up to. So in other words, we're going to look at our resistance levels. We want our strike to be above resistance. So then that resistance level is our protection. We want high implied volatility, or IV, so we can capitalize on the decreasing of IV over time. We want the expiration date to be between 30 to 60 days. We don't want to do this with very short-term options. If we do that, well, then we're too reliant on the movement of the stock. We are here to sell time, so we want the trade to have time in its favor. We want 75 cents or more in premium, so that's going to give us $75 or more per contract. And we want a delta of 20 or less. A call vertical spread is used when you are bearish on a stock. You create the spread above the price that you don't think the stock's going to go up to. And the call vertical spread, well, they're really the same as selling a naked call and simultaneously buying a higher strike call for upside protection. Remember, on our writing naked calls, the risk was unlimited because how high can a stock go up? So now our bought call protects us if the stock goes up. So let's have a look at an example here. Let's say the stock is trading at around $50. We could sell the 85 call and bring in $2 or $200 per contract. We could buy the $90 call for $1 or $100 per contract. So the total credit is going to be $1, which is $100 per contract. Notice how this brings in a credit into our account. That is why it is also known as a credit spread. Now, the maximum profit is the difference between the premium for selling the 85 call and the cost of buying the 90 call. Therefore, $100 per contract. Our maximum risk and our loss, the difference between the two strike prices less the credit for selling the 85-90 call spread. Therefore, the difference between the two strike prices is $5 or $500 per contract, and the credit for selling the 85-90 call spread was $1 per share or $100 per contract. So 500 minus 100 is $400. So in this example, you are risking $400 to potentially make $100 per contract. Our break even, the sold strike plus the maximum profit. So if the sold strike was $85 and the maximum profit was $1 per share, then the break even would be $85 plus $1, so it's going to be $86. In this example, the break even is $86. So we need the stock to stay below $86 prior to expiration. Our percentage return. To calculate the percentage return, you divide the profit by the risk and multiply it by 100. In this example, we're risking $400 to make $100. So the percentage return would be $100 divided by $400 multiplied by 100 gives us a 25% return. Not a bad return for a couple of weeks, eh? So long as the stock stays below $85 upon expiration, we keep the profits. Our margin. Bear call spreads, that's what this credit spread is called, a bear call spread. So they create a credit. However, your broker will require you to keep money on hold as a margin deposit. This is a deposit, not a cost. So you will get it back in addition to your profit or less any losses at expiration. If you close out your trade prior to expiration, you'll get it back upon the closure of the trade. To calculate the margin, you take the difference between the two strike prices, multiply it by the number of contracts, and then subtract the credit. This can vary from broker to broker. Let's use the $50 stock example. The spread was $5, which equals $500 per contract. And we bought in $1, which equals $100 per contract. Therefore, the margin requirement would be 500 minus 100 is $400 per contract. As you can see, the margin is the same as the maximum loss. So how do we win? Quite simply, so long as the stock stays below $85 upon expiration, you keep the profits. So as you can see here on that chart, look at the stock going up and down, up and down, up and down below our 85 strike. So if it goes sideways, we make money. If it goes down, we make money. Even if it goes up a bit, we still make money. Pretty awesome strategy, isn't it? Which calls to buy and sell? The nearer the strike is to at the money, the higher the premium will be. However, being a consistently profitable options trader is not just about the premium. We're not just looking at getting a great big premium to come in. We need to stack more odds in our favour. We're going to sell the call that is above resistance and then buy the next strike price higher. In other words, we're going to create the bear call spread at a price that we don't think the stock will go up to. Now, exiting our position. When our order is filled, we immediately place a new order to close out the position at 50% of the maximum profit. I'm okay with 50% of my maximum profit. That is my trading plan. That's what I aim for. I aim to get out of my trade at taking 50% of my profit and then getting into my next trade again. Just taking profits, taking profits, taking profits. Ka-ching, ka-ching, ka-ching. Money machine. If you have not hit 50% of the maximum profit the day before expiration, close out your position. Never let a sold call expire in the money or you will be obligated to deliver the stock. This is covered in great detail in my advanced training. Repair strategies. Here are 3 options that should your trade start going against you, in other words, if it looks like the stock is going to be trading higher than $85 upon expiration. Firstly, you could buy back the sold call and then sell the bought 90 call. That is called winding out. In other words, you're going to close out the whole position. If you've become bullish on the stock, you could buy back the 85 call that you originally sold and keep the 90 call, as that was a bought call and the 90 call is going to increase in value as the stock goes up. If you are still bearish on the stock and some news or an unexpected event caused it to go up, but you expect it to go down again, you could roll up to a higher strike price. For example, after you've bought back the 85 call and sold the 90 call, you could open a new position by selling the 90 call and buying the 95 call. To see what we've done there? We've rolled up to the next level. We've moved up $5. We've now got the 90.95. Well, before we originally had the 85.90. The credit that you bring in from rolling up quite often offsets the loss of closing out the original position. It all depends on how much time has gone by. Remember, we've got a credit coming in and we're selling time because these are all out of the money. So being out of the money, it is all 100% time value. So as time goes by, these options are becoming worth less and less and less. Repair strategies: by treating your trading as a business, being a professional trader by managing your trades, you can turn losing trades into winners, or at least minimize your losses. Here are some of my guidelines. Minimum credit. If you've got a $2.50 spread, I want 25% of that spread in credit. In other words, 62 cents or $62 per contract. A $5 spread, I want $1.25, which is $125 per contract. A $10 spread, 25% of that is $2.50, so in other words, $100 per contract. My expiration date, I look at 30 to 60 days out in time. I don't do this short term. I don't do this current month options. I want at least 30 to 60 days because I'm selling time. 100% out of the money options is 100% time. We need it to have time for it to, the time decay to come in for us to capitalize on that. We're going to take profit at 50% of our maximum profit. Our time in trade is generally around 20 to 25 days. So let's write a call vertical spread. Okay, we're looking at Boeing again here, BA. So let's have a look this time of placing a bear call spread. Now on a bear call spread, we want to sell a call at a price that we don't think the stock's going to go to. So we're going to sell it up here at the 180, and then we're going to buy the next strike further out of the money, which is going to be the 185s for protection. And that'll protect us in case Boeing goes right up. So let's go and have a look at that trade. Come over here, we're looking at July 17, and we're looking on the calls is on the left hand side here. And we can see I'm already in a trade here on this. I'm in calls and puts, so I'm in an iron condor already. So let's have a look at this of doing just writing a bear call spread. So we're going to sell the 180s and we're going to buy the 185s for protection. So before on our naked calls, we sold the 180s, and we also used the example of selling the 185s as well. So here we're selling the 180 and buying the 185 for protection. So that's going to bring in 85 cents a premium. So in other words, $85 per contract. That meets our rule of being greater than 75 or $75. So that's great on there. And we've defined our risk now. Our maximum loss on this trade is going to be $415. Why is that? We've got a $5 spread, so that's $500. Less the 85 is going to give us $415 maximum loss. Our delta is down here at negative 3.95. So that's great. That's lower than our 20. So that meets all the requirement there as well. So let's have a look at our rate of return. We're going to earn $85. We're bringing 85 in, and our buying power or our maximum loss, which is also our margin, is 415. And that's going to bring in a return of 20%. So that's pretty good. Now, with all of my trades, as part of my trading rules, is that when I execute a trade, as soon as that trade is placed, I go and place another order to get out of the trade at 50% of my maximum profit. So my maximum profit's going to be 20%, so 50% of that means I'm going to make 10% on this trade. So as long as Boeing doesn't go above $180, I'm going to make a pretty cool 10% return. And that, I estimate, will happen in about 1 to 2 weeks. So that's not a bad return. To place this trade, we simply click on Review and Send. So that's how quick and easy it is to place a bear call spread trade. Okay, that was pretty simple, wasn't it? Now, never let a bear call spread expire in the money. When should we let them expire in the money? Never. Never, ever, ever let a bear call spread expire in the money. You got that? Never. Now, when a call option expires in the money, this is what happens. I shouldn't even be telling you what happens, because it should never happen to you if you manage your trades. But if you have to know, here is what happens. A call option is considered in the money if the strike price is lower than the current stock price. The seller of a call option that expires in the money is obligated to sell 100 shares of the stock at the option strike price. For example, if the stock is trading at $110 at expiration and you had previously sold a $100 call, you are obligated to sell the stock to the buyer for $100. Therefore, you would lose $10 per share or $1,000 per contract. Now, margin call. If you let your bear call spread or any trade that has a sold option in it expire in the money, and you do not have enough money in your brokerage account to cover the option exercise, you'll receive what is known as a margin call. Your broker will then demand that you either add extra funds to your account or close open trades to cover the costs. If you do not comply, generally within 48 hours, your broker has the rights to close any of your open trades to cover the cost. Bottom line, we make money if the stock goes down, goes sideways, or goes up a bit. We don't care what the stock does. We don't care if it goes down. We don't care if it trades sideways. And we don't even care if it goes up a bit, as long as it doesn't hit our sold strike. How cool is that? Pretty awesome strategy, isn't it? The education process. Repetition. We must watch or listen to material 5 to 7 times before we fully comprehend it. Go over it again and again. I've covered a lot in this tonight. I've covered a lot of new material here, guys, that may be over your head. It may not be, but if it is over your head, so what? Just go back and watch it again. Watch it a couple of times, and then you'll get that aha moment, the moment the penny drops. Aha, I've got it now. Paper trade. Paper trade at least 10 profitable trades in a row before using real money when we learn new strategies. Practice makes perfect. Heard that before? Well, that's wrong. Perfect practice makes perfect. That's the 3 P's of trading. See, practice does not make perfect if you are practicing wrong. So we have to perfect our practice and make it perfect. Think big, as long as you have to think anyway. How about we think ginormous? Now, if you haven't joined my online trading room yet, it could really be your key to freedom. Can take you from working 60 to 80 hours a week to only 30 minutes a day. And no, you don't have to be like that picture on the left-hand side. You don't have to have 3 monitors there staring at them, analysing everything. That's my job. Yes, I have 3 monitors. That helps me to be able to find great trades for all the people that are in my online trading room. Because what I do in my online trading room is that you're virtually leaning over my shoulder, watching me place live trades. You could be like that family there on the right, having a great life, sitting on the beach, spending 30 minutes a day adjusting your trades. I have an offer for you now with my online trading room, where you'll get access to my advanced training videos and my trade alerts. $14 for 14 days in my trading room. Let me be your mentor. For today only, $14 for 14 days. You have no long-term commitments. That's purely a trial. You can cancel at any time, and I'll give you unlimited personal support. You'll get access to our exclusive Telegram group, so you can write to me directly and personally. And at the end of that 14 days, if you don't think you've received $14 of value, just send me a personal message and I'll refund your $14 and we'll part as friends. But $14 is a very small price to pay to get access to all of my advanced training and to also to be able to join in on our exclusive Telegram group. So hit the subscribe button below and I'll see you in the members area.